And it literally can form anywhere. And these gaps, because nobody, not even me, nobody knows where a new day is going to open at 6 p.m. No one knows where the market's going to open up on Sunday. So because those are variables in price action and price delivery, you have no idea what they're going to do. You don't know if there's going to be a bomb dropped on some country that's going to cause everybody to wig out and cause all kinds of panic. And that excitement is going to be used. And they'll open the price up extremely far away from the last closing price on Friday. And they will inspire and quote unquote engage and engineer sentiment. So when we're looking at order flow, we're referencing what the retail trader may be expecting in price action based on what books and theory they use, what they're looking for price patterns, like bull flags and head and shoulders and stuff like that. We don't like those patterns. I am teaching you not to draw any affinity for those things except for taking advantage of being against that principal idea. When there's a wrestling match between smart money and retail price patterns like that and harmonic patterns and things like that, they will lose. They will lose every single time if it's against a smart money idea. Now, when that wrestling match begins, you may or may not know at that moment that you should be expecting or anticipating it because you're relatively new. That's the benefit of seeing it over my shoulder. When I'm showing my charts and I'm talking over top of it, I'm giving you that 3 decades and 30 years of experience reading price action. You're seeing it through my eyes, and I'm doing my best, and I may not be effective, as much as I'm hoping to be, as far as articulating what should be happening next and what's going on. But over the year, listening to your feedback and such, I'll use it constructively if it's respectfully given to me. But there's also limitations as far as where I'm going to go and what I'm going to do. So, but real time, watching price, and as price is moving up, let's go back to that analogy of we're looking for higher prices. Let's assume for that moment, price is likely to go higher. It's going up to a premium level. It's going to a buy side liquidity pool. It's obvious the market wants to get up there. It just keeps pressing higher, higher, higher. And what we're looking at for order flow is, do every PD array that I would teach you and what you see me reference in real time 1-minute charts, is it providing support? Is it preventing price from going below 3 PD arrays? A buy program where markets are bullish and we're looking for price to continuously deliver. Delivering is constantly booking and printing new higher highs, not higher highs like in thinking like market structure, like you see people teaching market structure, higher highs, higher lows, higher high. Fuck that. That's too simplistic. That is not what I'm teaching you. You don't ever hear me teaching higher high, higher low bullshit. Okay, that's right out of retail books. Stop that. It's understandable and it's introductory. That's great. What I'm talking about is, does each individual candle, when it expands higher, when you're bullish and you're watching that buy program unfold, and it's digging in to higher prices and just keeps printing and creeping up and encroaching on that old high where buy side liquidity pool is resting, where real buy stops are resting. I'm teaching you to look at every individual candle and how it relates to the candles just before it. So it's going to create a small little stair step, and every little candle should support the new one. Every down close candle, I'm looking at that. This is the primary function of how I teach order flow. A bullish market, when the market rallies away and it's reaching to buy side liquidity, I'm watching, does the down close candles support price? That's a primary observation for me. I'm looking at that. By itself, that's going to serve you better than any of the bullshit out there you're looking at. You're looking at level 2 data. You're looking at, ladders and depth of market and volume profile. All that stuff is distracting you from just looking at the candles themselves, because they're going to tell you everything you need to see, and it won't divert or dilute your attention. You're simply looking at, how are the candles relating to one another? Is it continuously giving you constructive feedback that you are on side and expecting higher prices? Now, that's not to say that you won't see a break lower that comes back for a short-term low and takes out a pool of short-term sell stops. That's normal. That's absolutely normal, which is why I teach how you are not to be in a rush to move your stop loss. That's the number one reason why I tell you not to be in a hurry to move that stop loss up. I'm training you to trust and have conviction about where the market's going to go. Your safety net is your stop, but you don't need to have the safety net and training wheels and harnesses all around you because you're going to be too afraid to trade then. You have to step out there and embrace that uncertainty by watching the candles print, and that's essentially booking price. When that higher price is expected, that's gravitating towards that buy stops, every down close candle should support any return back on the new candle or a future candle that would trade down into it. It's going to expand higher and then pull back a little bit, expand higher and pull back a little bit. And the narrative behind what price is doing, you can read that and internalize how all the real order flow is coming in. I don't need a fucking chart to tell me how many orders were at every price level inside that candle. That's too much. That's too much information for me. I don't give a shit. I'm reading what the market's going to, I'm already going to know what the fuck they're going to be doing. I'm telling you that they're going to be buying here. Just listen to my commentary when the candles are forming. All right. It's going to go down here. It's going to stop here. I don't need to know what the numbers are, just like those reports. Who gives a shit what they say about the data? I don't give a fuck how many people lost their job. I don't know how many people's going to get a job. The employment data, it's all bullshit. It's old anyway. You can't do anything with that. So why waste your time on all that? It's extra shit. Focus on what matters most. That means the price right now. And as long as price is moving in the direction that you expect it to go to, down closed candles are supporting price. Now they can go through them. When would we expect price to go through them and not freak out? If there's a fair value gap, if there's a short-term low that has recently formed, and we are not in the upper quarter of where the price should go to for target. Let me say that again slowly so that we understand what I'm referring to. If you believe that you have figured out where the low is in the market for this particular price swing, and you think it's going to go up to an old high where buy stops and buy side liquidity is, that midpoint of that run, that will be equilibrium. Now that range is not really there yet. You're just implying that that's where it's going to likely go. So therefore, between where you think the beginning point of that run is, the low, you may or may not actually be in the move yet. But assuming that you are or aren't, who cares? The midpoint of that equilibrium price point, at that point or below it, that's where your best buys are going to occur. But now, as soon as we get to the upper quarter of where that target is, you're going to see less likely retracements to a stop that would be below old lows. Like in other words, the market's not likely to go back for sell stops. Now it can, but largely it doesn't. And this is getting back to when I was teaching you this week how to, when you're pyramiding and you're adding more to a winning trade and you're building your positions up, as soon as you cross the threshold of the opposing side of that discount to premium or premium to discount range, and we're going to use the analogy I'm talking here, we are in a buy program. That means they're expecting higher prices. It's going to go to a premium inefficiency fair value gap or an old high to run out stops. So that's the magnet, that's the draw on liquidity. So as the market goes higher, whether you got in at the low that started that price run or didn't, you got to know exactly where to go back to see the beginning of that move. So that point of inception and where your target is, which is terminus, between those two price points is equilibrium. That's where the difference between discount to premium, that's where it starts and ends. But if you go halfway between equilibrium to your target, which is terminus, that's in premium range, not discount. In other words, think of it like now we're overbought. I'll talk to the folks in here that are used to listening to and understanding retail logic. As soon as we get to the final quarter of the run that gets to the target, As soon as we get into that vicinity in terms of the price run or range of how far it's been moving up, it's less likely to see a stop run below old lows. Why would it be like that? Because it's going to be in a hurry to run out the buy stops because they may catch wind about what's likely to occur. You know what it's like to be short and your stop sitting above an old high. You're praying you become a Christian then, don't you? You're looking for Allah, you're looking for Jesus, you're looking for whoever. Somebody answer me. You become religious then. Even the atheist starts praying because you know as it's getting closer to your stop, it's likely to do what? Run for it. And that's why the market is less likely, not that it's impossible to do so, but it's less likely for it to come back against you and run sell stops before it runs to your target because it's going to be in a hurry to reprice because it doesn't want to give the opportunity for those orders to be pulled, close the trade and collapse and reduce the amount of liquidity for smart money traders. That's why the algorithm's coded that way. It's coded to do that very thing because right above those highs, it is not aware of the human aspects of, oh no, I'm scared. Let me just close my trade and protect the stop for those that are smart. It just knows that once we get to that last quarter of the price run, accelerate. Boom, 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 boom. That's why you see me talking about, and you see me here now this week, and you watch me do recordings of executions. I'm looking for speed. I'm looking for the big range candles expand up and run into that liquidity. Pow! That is a purge of liquidity. Stop calling it a liquidity grab. That pisses me off. It's not what it is. It's a purge of liquidity. So order flow, we're looking at how those candles support one another and how if there's any retracement, it's only going to retrace down to the nearest fair value gap below price. Well, we're in a buy program and it's moving higher, reaching for buy side liquidity. Or every down close candle will support price. Everything I just said, reverse it when you're looking for lower prices. Every up close candle should resist price from going any higher. Now, it does not mean that up close candles, while the market's bearish, can't be breached and traded above. Because if there's a fair value gap above it, it's reasonable to expect that. It doesn't undermine the efficacy of what I'm teaching you. It just means that the market's going to go back and offer fair value to the marketplace, which is going to be identified by you as a smart money trader as a new opportunity to add or enter. If you haven't been a participant in the trade yet, that could be your invitation and means of accumulating a short position at that moment and not be in the best case entry point. And that best case entry point is relative. Even though everybody would like to say, okay, I want to get in at the very low and buy that low, your skill set may not permit that yet.